Diane Kowalski is 63 years old. She lives in Columbus, Ohio. She has $650,000 saved for retirement, and she's 2 years away from leaving work for good. Last week, she watched a YouTube video. It promised her $15,000 a month from just 3 ETFs. She wrote the number down. She circled it. Then she got out her calculator and ran the math herself. It didn't add up. By the end of this video, you'll know the real income that the best ETFs for retirement income actually produce. Not the headline yield, not a 30-year projection, the actual number that hits your bank account after federal taxes, after state taxes, and after Medicare. And the one decision that changes that number more than any ETF you'll ever pick. But here's what none of those videos ever say out loud. 2 retirees can hold the exact same ETF, collect the exact same income, and one of them pays $10,000 more in taxes than the other every single year. The difference isn't which ETF they chose. It's something most creators never mention. Quick note before we start. I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always work with a qualified professional. So let's start where Diane started, at her kitchen table, with a napkin, a calculator, and a number that wouldn't add up. Because the question she was quietly asking is the same one most people in their early 60s are asking right now. How do I build retirement income I can actually count on? And how do I keep as much of it as possible? The promise versus the paycheck. Diane ran the math herself. She looked up the yields on those 3 ETFs. She multiplied each yield by the projected portfolio size. She didn't get $15,000. She got closer to $4,000. She wasn't doing anything wrong. The video just never told her the full story. The $15,000 figure came from spending projected price gains as income. That's a different strategy, and a much riskier one when you're withdrawing every month in retirement. So Diane kept digging. She started reading about how dividends are taxed, and that's where things got more complicated than she expected. Here's the number most videos skip entirely. The most expensive mistake in retirement income isn't picking the wrong ETF. It's not understanding how your income is classified and which account it belongs in. Most people approaching retirement have never been told this. They've spent 30 years saving. They're 2 years from the finish line, and they suddenly realize the rules change completely at retirement. The strategy that worked during accumulation doesn't automatically work during distribution. That feeling Diane had that something important was missing was completely right. But here's what's also true. Once you understand 2 things, the entire picture changes. One is about the type of income your ETF produces, and the other is about where that ETF lives. And both of them fit on an index card. But here's what those 2 things actually are, and once you hear them, you'll never look at a dividend ETF the same way again. One of them almost cost Diane more than $1,000 a year, and she had no idea. So now you know the gap Diane found. But here's where most people make the costly mistake, and it's not what you'd expect. Here's what I mean. Diane had been researching JEPI, the JP Morgan Equity Premium Income ETF. It yields around 7 to 8%. It pays every single month, and it shows up on nearly every retirement ETF list online. She was ready to move $100,000 from her taxable brokerage account into it. Then she sat down with her accountant. He asked her one question. Do you know how JEPI classifies its income? She didn't. Here's what he explained. Not all dividends are taxed the same way by the IRS. Qualified dividends, the kind most established U.S. companies pay, get a preferential rate, 0% for many retirees in lower income brackets, 15% in the middle, 20% at the top. Ordinary dividends are taxed like wages, your full marginal rate, whatever your bracket in. What if the most popular retirement ETF on YouTube has the biggest hidden tax problem in a taxable account? JEPI generates roughly 80 to 85% of its distributions as ordinary income. That's not a flaw in JEPI. That's simply how covered call strategies work. The option premiums JEPI earns are classified as ordinary income by the IRS. The myth: a high-yield ETF puts more money in your pocket. The truth: a high-yield ETF puts more income in your brokerage account. How much reaches your pocket depends entirely on how that income is classified and where the ETF lives. Here's what Diane almost did: $100,000 in JEPI inside her taxable brokerage account. That generates about $7,500 a year in distributions, but roughly $6,375 of it gets taxed at her full marginal rate. That's over $1,000 more in federal tax every year than she planned. Every year. For 20 or 30 years of retirement. Diane's accountant paused. Then he said something she didn't forget. The ETF isn't the problem, Diane. The account is. So if JEPI is a tax trap in the wrong account, what's the right account? And where does each ETF actually belong? The answer is simpler than you'd expect, and it fits on an index card.
It's not what you own, it's where you own it. So now you understand the problem. But here's where the relief starts. And this is the part that changes how you think about every ETF you'll ever hold. Here's what I mean. Diane's accountant drew a diagram. 2 boxes, taxable brokerage account on the left, Roth IRA on the right. Then he placed the ETFs. SCHD goes in the taxable account. The Schwab U.S. Dividend Equity ETF pays nearly 100% qualified dividends. That income already gets the IRS's preferential rate, 0% for many retirees by law. Putting SCHD in a taxable account captures that benefit in full. Moving it into a traditional IRA works against you. All IRA withdrawals are taxed as ordinary income, regardless of what's inside. VIG goes in the taxable account too. The Vanguard Dividend Appreciation ETF yields about 1.6%. Its dividends are mostly qualified. Its real job is long-term dividend growth and inflation protection. Low yield, low tax drag, long runway. JEPI goes in the Roth. Only the Roth. Inside a Roth, income is completely tax-free. It doesn't matter how JEPI classifies its distributions. In the Roth, there is no tax at all. That 7 to 8% yield becomes your actual yield. No bracket problem, no surprise at tax time, just income. The account matters more than the ETF. That's not an opinion, that's the tax code. This is the principle that changes everything. The tax character of an ETF determines which account it belongs in.
Income is not the number on your statement, it's the number that clears your bank. Diane looked at the 2-box diagram. She said, "I almost put it in exactly the wrong place." She was right, but now she had a plan. Here it is: 40% in SCHD, taxable brokerage account, 30% in JEPI, Roth IRA only, 30% in VIG, taxable brokerage account. Blended yield of roughly 4.2 to 4.5%, a growing income stream, built for the distribution phase, not the accumulation phase. Now let's put real numbers on Diane's $650,000, because when you see what correct placement actually produces after tax in her hand, the result is more grounding than any headline number you've seen online. Diane's real paycheck. So now you have the blueprint, but here's where the real numbers land. And this is where most people are genuinely surprised by what correct placement actually produces. Diane places her $650,000 correctly. $260,000 in SCHD in her taxable account, $195,000 in JEPI inside her Roth IRA, $195,000 in VIG in her taxable account. Here's what that produces. SCHD at roughly 3.5% yield, about $9,100 a year. almost entirely qualified dividends. At Diane's income level, likely taxed at 0% federally. JEPI at roughly 7.5% inside the Roth, about $14,625 a year. Completely tax-free, not 22%, not 15%, zero. VIG at roughly 1.6%, about $3,120. Mostly qualified dividends, also likely 0% at her income level. Total, about $26,845, about $2,237 a month. That's not $15,000, but it's real, it's reliable, and it grows every year because all three of these ETFs have consistent dividend growth histories. What if a married couple in Ohio could receive $80,000 in income and owe less than $600 in combined taxes? A married Ohio couple, both 65 or older, $50,000 in qualified dividends from SCHD in a taxable account, $30,000 in Social Security. Dividends structured correctly, they could owe approximately $0 in federal tax on the dividend income, about $540 in Ohio state tax on the taxable portion. On $80,000 of income, they keep 99 cents of every dollar. That's not a loophole. That's what qualified dividends, the standard deduction, and correct account placement produce together. Here's what realistic income looks like at different portfolio sizes at a 4.2% yield. $500,000 produces about $1,750 a month. $750,000 produces about $2,625 a month. $1 million produces about $3,500 a month. $1.5 million produces about $5,250 a month. These are pre-tax estimates. After-tax will vary based on your income sources and account placement, which is exactly why placement is never optional. Before I show you the final blueprint, drop a comment right now. What's your biggest question about taxes on dividend income in retirement? I read every comment. Now there's one more thing Diane needed to understand. Almost everyone who hears it for the first time is surprised. It's called the Social Security tax torpedo. The IRS uses a calculation called combined income to determine how much of your Social Security is taxable. Combined income is your adjusted gross income plus half your Social Security benefit plus any tax-exempt interest. Here's the trap. A married couple with $30,000 in Social Security and $15,000 in dividends has combined income of $30,000. Below the threshold, none of their Social Security is taxable. Now add $5,000 more in dividends. Combined income rises to $35,000. Now $1,500 of their Social Security becomes taxable too. That extra $5,000 in dividends didn't just get taxed itself, it made another $1,500 taxable right alongside it. In that zone, your effective marginal rate can hit 40%, even if your statutory bracket is only 12%. This is one more reason JEPI belongs in the Roth. Roth IRA withdrawals don't count toward combined income. That keeps you in control of the torpedo zone. One final number. If your total income as a married couple crosses $218,000, Medicare Part B and Part D premiums can jump by roughly $2,297 a year. It's called IRMAA. It's a cliff, not a gradual increase. $1 over the threshold triggers the full surcharge. If your portfolio is growing toward that level, plan around it before you get there. This is exactly the kind of thing smart retirees check for, and once you know it, you won't overlook it. So here's the question Diane asked herself after running all of this through. What does this actually look like, written down, in a form I can use every day? That's the last piece, and it fits on an index card.
So here's where Diane's story ends, and where yours begins. Diane went home that evening. She sat at the same kitchen table, this time without the calculator. She took a blank index card. She wrote 3 lines. She taped it to the refrigerator. Line 1, SCHD, taxable account. Line 2, JEPI, Roth IRA only. Line 3, VIG, taxable account. Under those 3 lines, she wrote 4 words: know the account, keep more. That card is your blueprint too. This isn't about finding the 3 most popular ETFs from a YouTube list. It's about understanding something most retirees are never told. The same income, structured correctly, can cost you almost nothing in taxes. That same income, placed carelessly, costs you thousands every year of retirement. If you've made it to this part of the video, you already understand more about retirement income taxation than most people your age and most financial content creators. Here's the final blueprint. SCHD in your taxable brokerage account. Qualified income, tax preferred by law. JEPI in your Roth IRA only. Ordinary income made completely tax-free by placement. VIG in your taxable account. Dividend growth, your inflation hedge for the long run. Keep an eye on your combined income as you draw Social Security. Know your IRMAA threshold if your portfolio keeps growing. And if you have money sitting in a traditional IRA, a Roth conversion conversation with a tax professional may be the most valuable thing you do this year. Diane has her plan, now you have yours. Income is not what you receive. Income is what you keep and can count on.